I'm Taylor Ricks in for Emily Chang. This is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up, the beat is on. Apple's fourth quarter results beat across the board despite sputtering iPhone sales. For Facebook's third quarter profit and sales top estimates, we have complete coverage. Plus, Twitter's political ad ban. CEO Jack Dorsey does what Facebook's Mark Zuckerberg would not. Twitter's banning political ads of all types. We have details. And Tesla owners talk. Bloomberg conducts the biggest survey of Tesla drivers to date, 5,000 in fact, what they have to say about what Elon Musk is doing right and wrong. Now, this week was dominated by tech earnings. Apple beat across the board Wednesday, topping estimates for both last quarter results and next quarter's forecast. This all despite sputtering iPhone sales. Highlights included sales and profit that's topping analyst projections. Services revenue also reached a record high. The CEO announced Apple will launch a no-interest iPhone payments on the Apple Card, adding that the Apple Card is the most successful launch for a credit card in the U.S. ever. I got insight from Forrester analyst Julie Osk and Estimize CEO and founder Lee Drogan.
We had been seeing upward revisions to basically all of the numbers throughout the quarter, so it's not a surprise that the stock had performed pretty well coming into the report. That said, especially on the services side, this was a really large beat. That and the gross margins number were very unexpected. And then obviously the guidance for the holiday quarter was very good. Now, I want to put that in context, though, because when you look at the iPhone numbers and when you look at the expected revenue numbers, the midpoint of that guidance number for the holiday quarter is about $5 billion below the all-time high, which was last year. So in terms of Apple's business, they're going to be a smaller business. The financialization, though, of the business itself has led to higher EPS and a higher stock price.
Julie, as we know, the company, 52% of the revenue still comes from the iPhone. So it does still all come down to those iPhone sales. I'm showing a chart here in my terminal at GTV Go talking about the average sale price. As they've lowered that, actually, the number of phones are slowly starting to pick up. How much of this demand are you seeing, particularly perhaps around the iPhone 11?
Yeah, so I think certainly, lowering the prices can either bring more consumers into the market or it can speed up replacement cycles. As the phones have gotten more expensive and certainly they rival and sometimes are higher priced than even laptops that are in the market, consumers have slowed down. If we were to look back 5-6 years ago, the replacement cycle was much closer to 2 years, and now it's up beyond that.
Lee, did we see in this quarter people replace their older phones faster than we thought? And is that also what's driving next quarter's forecast for iPhone sales as well?
It doesn't look like that, actually. I think Julie's got it here, that replacement cycle is expanding. And I think, look, myself and my wife are good examples here where, I have the 10 and she's got the 7, and neither of us upgraded this year because we're looking forward to something new, something that's actually a game changer in terms of the hardware. And there's really nothing there. Now, the next cycle looks like we're going to get 5G, and that's where both of us will obviously upgrade, and I think you will see that upgrade cycle tick up again. I think the market basically baked this in, that you're going to get, a lower upgrade cycle. The other issue is that out in China, that upgrade cycle is also slowing significantly because they're working off of comps from the last year where that upgrade cycle was very high when Apple didn't really have a large phone to sell into China than it did, and now we're on the back end of those tough comps. So it's going to take a little while for that to kind of burn off. And then again, that 5G upgrade cycle you might see pick up again.
And Julie, we were talking a little bit before the show, and as we want to focus on iPhone, more and more we just want to talk about services as well, because that is the higher margin business of the company. Mm-hmm. I'm showing another chart here in my terminal showing the growth of that services business, which is rebounded up 18% here. How much of that services business do you see really pushing growth going forward for the company?
Yeah, so I think it's absolutely essential to Apple as we look forward. On one hand, they've got more services in the market with bringing the TV service and the arcade service in. And if you were to look at somebody opting in to buy all of their subscription services, you could be up over $500 a month per consumer on an annualized basis. And services, because they are subscription, tend to be stickier. I think the other advantage that Apple has here in the market is they have a lot of billing relationships and do have billing relationships with almost all of their customers, and that also just makes it easier to convert customers and to keep them.
That was Forrester analyst Julie Osk and Estimize CEO and founder Lee Trogan. Now, Facebook also was one of the most anticipated tech companies out with earnings this week. The company impressed Wall Street Wednesday by posting strong third-quarter sales, and this is all despite regulation woes and doubts about its cryptocurrency plans. CEO Mark Zuckerberg remains defiant on the investor call.
I expect that this is going to be a very tough year. We try to do what we think is right, but we're not going to get everything right. This is complex stuff, and anyone who says that the answers are simple hasn't thought long enough about all the nuances and downstream challenges. Now, I get that some people are going to disagree with our decisions. I get that some people are going to think that these decisions may have a negative impact on things that they really care about. But I don't think anyone can say that we're not doing what we believe or that we haven't thought hard about these issues.
For Inside, I turn to Bloomberg Intelligence senior analyst Jitendra Woral.
It has been a big topic for the last couple of quarters, and it will continue to be so, like going into the election year. But if you look at the business side of things, that's humming well. I mean, they came ahead on every metric there was, including margins where there were some worries. Now, they are projecting a slowdown in 4Q. It might be a little conservative. There are some comparison issues in 4Q with respect to product changes and things like that. But what this quarter is really showing is Facebook is setting up here next year for its newer businesses to diversify beyond advertising. So you're talking about e-commerce, you're talking about payments, and that's what's going to be the story all about from a business standpoint. As far as the regulatory aspect is concerned, I mean, that is going to be an ongoing discussion, debate, argument throughout next year, but the business side is sort of stays untethered.
Are we seeing any cyclicality in their ad revenue around the election cycle? We know that Facebook and Google just continue to dominate the ad space, but are we starting to see any cyclicality there?
It's not that big in terms of their total revenue. So if you look at, say, Facebook or Twitter, the political ads is a very small portion of their business. So not a lot of cyclicality in terms of revenue per se, but there's some organic traffic, more eyeballs that do come along the way. That may help Twitter more so than Facebook, but cyclicality based on elections, or at least on the business side of things, it shouldn't sway the results much.
Not to be a total negative Nancy, but I think there were some concerns that the margins beat because we were looking for a margin miss to see that they were spending money on cleaning up that platform. Are they doing enough to clean up the platform? And
they are accelerating hiring next year. So if you look at their guidance for cost and expenses, $54 to $59 billion for 2020, they usually give a higher guidance early on and then taper it off. But it's basically telling you that the headcount growth will continue to increase. Going into election year, they are being more cautious with these improvements and henceforth. And this is really going to be a moving target over here. This is not a one-quarter fix or a one-year fix, really. This is going to be an evolution of the infrastructure spending and how they allocate personnel. So at least, from a financial standpoint, they are making sure that there's capital and spending allocated or baked into expectations for next year, especially going to election year.
That was Bloomberg Intelligence's Jitendra Woral. Now, later this hour, we'll hear from Facebook's COO, Sheryl Sandberg, who sat down for an exclusive interview with Bloomberg after the company reported earnings on Wednesday. Again, that interview later this hour. And coming up, political ads on social media sites like Facebook coming under scrutiny. Twitter makes a big play, announcing it will stop accepting ads from candidates for elected office. Details ahead. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Twitter announced on Wednesday it will ban political advertising from its platform globally starting November 22nd. CEO Jack Dorsey tweeted the move, saying, quote, "We believe political message reach should be earned and not bought." Bloomberg Opinion's Shira Ovide said Twitter's decision clearly upstaged Facebook. She weighed in on the matter Thursday.
He was already under some considerable pressure, right? If you have people like Joe Biden and Elizabeth Warren and Alexandria Ocasio-Cortez all piling on, criticizing Mark Zuckerberg and Facebook for their policy about political advertising and political speech on Facebook. I'm not sure Jack Dorsey really tips the scales that much more, but certainly what Jack Dorsey and Twitter did on Wednesday, it takes away one of Mark Zuckerberg's arguments, right? That his peers at Twitter and Google are all doing the same thing when it comes to political advertising, and Dorsey basically said, nope, we're not.
Shira, at 0.5% of revenue, which is the political ad contribution to Facebook, why even get in this controversy to begin with?
I think that's a great question, and certainly that is a point that many people have made, that Facebook would not be giving up really that much revenue if it decided we're just going to stop taking political ads and just take ourselves out of this part of the conversation. I think the argument that Mark Zuckerberg is making, and you can say it's the wrong decision, but it does feel like he really believes it, is that Facebook doesn't want to be in a position where they're asked to censor political speech. Right. And he really sees this as kind of a free speech argument. And there's certainly a lot of people, particularly conservative politicians, who agree with him. And it does feel like a principled stand rather than a stand that is motivated entirely by money.
Shira, if Facebook has 0.5%, I was hearing statistics thrown around that Twitter then has 0.05% of their revenue coming from political ads. So why their decision to weigh in here?
Yeah, look, for Twitter, it's a little bit of an easier decision to say, we're going to stop taking candidate ads. We're going to stop taking ads that are related to sort of hot button issues like healthcare or abortion or taxes, because those kinds of advertisements are a teeny fraction of a company that is already a fraction of the size of Facebook. So Twitter has never been a place that was either large enough or where the ads are targeted enough to be appealing for political related advertising. And so Dorsey, look, give him credit for taking a position and sticking to it. But it's also true that it's a little bit easier to take that kind of stand when the advertising that he's talking about is relatively insignificant for Twitter.
Shira, you write a Bloomberg opinion column and you get hundreds of comments and emails coming in. Using that as a sample data, who is right here?
I don't think my email comments are necessarily representative, but I do feel like the Facebook is in this cycle where nothing they do is right. And there's a little bit of unfairness to that, but it's also true that, look, they're a place that has an audience of a couple billion people plus on a daily basis, and the choices they make have an extremely large impact both on what people see, who gets seen, whose voice gets heard, and that's why there's so much attention on the policy choices that Facebook makes and on how they write their algorithms, that the choices of one company controlled almost entirely by one man are so important in the discourse of the country and the world.
Shira, you write a very obvious question that I had failed to ask up until this point, which was, how did Google manage to stay out of all of this?
I don't know. To me, this is one of the great mysteries of online advertising controversies the last few years, is that Google has sort of managed to stay out of the fray. So Google is the largest advertising seller in the world, and they somehow, while Mark Zuckerberg has taken these principled stands on free speech and gotten criticized by everybody from the president on down for how they handle political candidates and their advertisements on Facebook, Google has said nothing, that as far as I can see, and they haven't really been called to account. I can't imagine it will stay that way, but so far they have just kind of let Mark Zuckerberg take the fire.
That was Bloomberg Opinion's Shira Ovide. And coming up, our complete earnings coverage continues with Alphabet posting a few misses in the third quarter. We have details next. And Bloomberg conducts the largest survey ever of Tesla Model 3 owners, what they think about reliability, design, and function. This is Bloomberg. While Facebook and Apple beat earnings, Alphabet, which is Google's parent company, delivered a mixed bag when it reported third quarter earnings on Monday. Operating income, earnings per share, and even paid clicks missed estimates. But the company did say it's investing heavily in thousands of new jobs geared towards Google's cloud computing business. According to CEO Sundar Pichai, cloud computing and machine learning continue to be the company's priority. I got reaction from eMarketer analyst Nicole Perrin, and once again, Bloomberg Intelligence's Jitendra Worrell.
They are spending in ramping up cloud, but it's showing results. So 39% in the segment that they house cloud, it's pretty strong. Probably cloud is going much faster than that. And what we are seeing over here is, for the next really year, cloud is going to take center focus as they push into enterprise, and they are getting some early success over here, and they have the capacity to compete with Amazon and Microsoft. So you're going to see cloud becoming a bigger and bigger deal for Google, but it'll come at a cost as they scale that business, and that's what you're largely seeing in the cloud business.
And Nicole, what is your take on the cost of keeping up and gaining market share in that cloud business?
Well, it is going to take some continued investment, as we just said, but I think there is the potential for a huge payoff on that side, and we have seen some major contracts awarded to competitors recently, so I expect Google to keep investing in the hopes of winning some of that business in future.
I want to talk, Jitendra, about the income statement because it seems like a broad-based miss. Top line revenue comes in line, but operating income, margins, and then the bottom line seem to be a miss all in a row. Is it a revenue problem or an expense problem?
It's not a revenue problem. I mean, if you look at their core ad business, there's a dynamic where the ad pricing is improving. We see a search becoming more and more valuable on mobile as it gets crowded with the space. So there's some impact that you will see in terms of improving ad pricing because of that, and that's offsetting the 18% increase in paid clicks, the volume of ads, if you may, that you're seeing. So this dynamic will keep playing. I think the ad business will keep humming well, but the cloud business is where disclosure could be a bigger deal for them next year, because at scale it is a very profitable business, as we have seen with other competitors, and Google has the scale. And if they can come out and show that disclosure to the street, like, look, this is how fast we are growing vis-a-vis others, and this is the profitability, which it could very well happen next year. It could spur a re-rating for the company.
Nicole, I just got off the phone with the CFO, Ruth Porat, and she said it was a very noisy quarter, which broadly led to the miss in the margins and the bottom line. On the expense side, there was a one-time legal expense that they had to pay for, but there was also an unrealized gain or loss, which had to do with some accounting changes and how you now have to mark to market some of those unrealized losses on your income statement. Namely, we think it's Uber and Slack. She wouldn't specifically clarify that those were the companies, but is there a real impact that the venture capital arms of these companies can really start to hit the income statement and lead to some bottom line misses relative to where you think they should be?
I think that is possible. I mean, I think for me, my biggest takeaway from Google, we do focus really heavily on the ad side, and they beat investor expectations as well as our expectations for their gross ad revenues. And we see, although CPCs are continuing to decline a little bit, overall paid clicks are way up, as we said. Additionally, traffic acquisition costs have continued to stabilize, and that was something that had investors worried. They peaked earlier this year. They've dropped slightly since then, so I think that's a really good sign for the bottom line on their ad business.
Jitendra, so we've talked a lot about the ad business. Last week, we sat here and we said the same thing about Amazon, that ad business is so strong for that company. It's a lever that they can pull. How mature is Google and Alphabet's ad business, or are there still some more levers that they can pull?
Well, mobile search still has room to grow. They are still trailing peers in terms of concentration of revenues coming from that. And, as the results show, it continues to be a very valuable franchise for the company, and they are the market share leaders. So we expect the momentum to continue there. But with Amazon and Google side by side, they're switching roles where advertising will come at the forefront for Amazon going forward as a cloud business, faces law of large numbers, while Google is going to start showing more results on the cloud front. So you're going to see this dynamic play out, which really plays well for both companies. I mean, that the market is growing at a very healthy clip. There is enough room for the three of them to enjoy good growth. But disclosure on both companies, advertising on Amazon and potentially cloud on Google, is what could make it more exciting.
And quickly, Jitendra, you had a good note on this, that ad revenue had accelerated in 2018. You had a little bit of a slowdown or a moderating of that pace in 2019. Did this quarter give you enough to see sort of a reacceleration of ad revenue, or are there still some pockets of worry, let's say?
For Google, I think the dynamic of ad pricing improving to offset any slowdown that we see in paid click growth in general would continue because they're market share leaders, because search is in many ways a mature business, but there's enough room in the mobile side to keep that business humming at a healthy clip. But cloud will take over the center stage.
Hey, Nicole, I mentioned that we'd spoken with the CFO, Ruth Porat, earlier. I want to bring up a quote when I asked her specifically about YouTube. There is arguably, outside the cloud, YouTube could be a big future growth area for the company, and she did reiterate that there, saying that we continue to deliver growth. We're excited about the upside potential. Brand advertising is growing at a healthy pace. Are you getting enough of an outlook going forward into the next few quarters as it relates to YouTube to make you confident that that can continue to be a driver?
I do think that YouTube will continue to be a driver. We certainly haven't seen anything that suggests otherwise. Advertisers are very keen to spend on video placements. They'd love to have more video inventory, especially video inventory where they can target at scale, and YouTube is the absolute #1 place to do that.
But Jitendra, there's been a lot of controversy sometimes about YouTube. Are they doing a quick enough job of pulling down content? There's a broader concern about data privacy and misinformation. Right. What's the downside risk here with YouTube?
Well, the downside risk really is more on the profitability side of the things. Like we just said, that the momentum in advertising will continue to be strong. But because it's shared infrastructure, search is sharing infrastructure, YouTube is sharing infrastructure, cloud is sharing infrastructure. So if you sort of look at their cost profile individually, I mean, search would be significantly more profitable, and that sort of helps them, keep YouTube humming at a good clip on a top line basis. So I think YouTube will keep helping the top line, but as far as disclosure is concerned, we don't think YouTube numbers would be disclosed anytime soon. It'll be hard to see that, but cloud, there's a real potential.
That was eMarketer analyst Nicole Perrin and Bloomberg Intelligence's Jitendra Worrall. And coming up, we asked about 5,000 Tesla Model 3 owners what they think about the car's reliability, function, and design. Those results next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs in for Emily Chang from San Francisco. Despite reporting surprise third quarter profits, Tesla revealed in an SEC filing this week that the automaker saw a nearly 40% drop in U.S. sales. Sales in China, however, rose to almost $700 million from $409 million. The filing was revealed the same week that Bloomberg unleashed a wide-ranging survey of Tesla owners. Bloomberg polled nearly 5,000 Model 3 owners with a 164-item questionnaire. The data reveals that Tesla has finally figured out how to deliver cars with fewer problems. But that is not all it revealed, as Bloomberg News' Tom Randall explains.
I think what we're seeing here is an artifact of them continuing to expand their geographic footprint overseas. So looking at that year-over-year number, we're comparing that to the third quarter of 2018, and that's when, Tesla finally figured out how to really mass-produce cars, and they started cranking them out, and they flooded the U.S. market with the Model 3 to satiate 2 years of built-up demand. So after they kind of satiated that demand, they moved in February to start selling cars overseas, and so of course their U.S. numbers dropped considerably. I think some people will look at that number and say, oh, is this a warning signal that U.S. demand is dropping off a cliff? I just don't think that there's a lot of evidence to support that. If you go to Tesla.com right now, there's a 2-month wait to get a Model 3, and that's, I think, the longest wait that they've had since about this time last year. I think it's a signal. It's representative of what's happening as they expand overseas and kind of smooth out their production. But it was a record quarter for unit sales, and I think we're going to continue to see that ramp up as we see their Shanghai factory going.
Well, and Tom, you're not just sitting there being a talking piece. You're actually doing the work and rolling up your sleeves and questioning 5,000 Tesla owners. Generally, as you take a look at the first part of the survey, what is the key takeaway? Okay, yeah, so this really is a massive survey. I mean, it's nothing like that's ever been conducted for Tesla. And what we really wanted to get at is now that Tesla is cranking out 100,000 cars about per quarter, what is the experience of owning one? And can they provide the kind of quality and experience of a Volkswagen or a Toyota that's going to attract the next round of more mainstream buyers? So we started by looking at quality. There's two kinds of quality. There's the driving performance and high-tech features that people love about Tesla, and people just raved about those things. And then there's the kind of quality about manufacturing quality and precision. And we measured that by asking first, how many problems did you have with your Tesla when you first received it? And we found that rate peaked in Q3 of last year, that we were just talking about. And in that quarter, you'll remember, that's when Tesla famously created a whole new production line in their parking lot under a tent structure and tripled production. And since then, their defect rate has dropped significantly, and it's down 44% in the third quarter of 2019. That was Bloomberg's Tom Randall. As for the electrification of vehicles like Tesla, we saw plans this week for another automaker embracing EVs. On Tuesday, General Motors laid out an aggressive approach to electrifying its vehicle lineup, saying the bulk of R&D will be spent on EVs and not combustion engine cars. But is the demand for EVs strong enough to support strategy shifts? I asked Morgan Stanley analyst Adam Jonas, who covers the auto industry and shared mobility.
Here we are 111 years after the Model T. The average car on the road emits almost 5 metric tons of CO2. Okay, there are 40 tons per second of CO2 emitted by all the cars in the United States. That's 40 tons a second. And yet the world's most valuable auto company, Toyota, makes 0 EVs today. It's kind of a shock. And then on the flip side, you have the world's most shorted auto company, Tesla, that only makes EVs. So something has to give, and investors really want to understand how to play that multi-trillion-dollar shift in capital as we reinvent this industry. Something has to give.
And how does technology play into this? I think of early days at Tesla when I wasn't sure if Tesla was a tech company or an automotive company. Where is technology in this?
So we think Tesla is more of a software company and a hardware-software fusion company that in an ideal world will be covered by a tech hardware analyst rather than the auto analyst community. So we'll take what we can get. We think the connection between tech and autos is when you see these large the trillion-dollar tech platforms like Amazon, Alphabet, and Apple that are clearly have their sights set on the auto industry as a domain. Not necessarily to make cars, but perhaps Apple wants to turn your car into an Apple store, right? And so as they try to look at this Internet of Cars marketplace, it's a multi-trillion-dollar market, they are getting drawn in to that 40 tons per second in the U.S. ecosystem. And it's happening within cities where a ride-sharing vehicle might emit 25 tons in a year, 5 times more than the average car. And so as tech firms get close to that autonomous vehicle topic and the shared and connected car, they're being drawn in, and they have the resources and the capital and, frankly, the obligation to do something about it.
You know, Adam, also in your other latest report called the Global Electric Vehicle Market Monitor in October of 2019, you talk about within the U.S., we're down year over year, but we're up year to date in terms of U.S. sales in the battery electric vehicle market. As you look out into 2020 and beyond, paint the picture for me. Where are we? Is there demand?
So we think the stock market is still defining EV adoption through the completely wrong lens, Taylor. They're looking at it through the lens of wealthier people buying cheaper and cheaper Teslas in a suburban community for your home, like the retail experience of personal ownership. That's going to grind along, and I think that your segment before, Tom, I believe, who did that 5,000 survey on Tesla, was absolutely spot on with his observations and conclusions. But we think that where the stock market is moving to now in terms of analyzing EV adoption, it's fleets and it's shared vehicles. So in order to make the large shift to get to like 2% EV adoption in the US to 10, 20%, it's going to be the regulatory purview of a dense community like a city going after logistics, taxis, shared mobility fleets. That's how you can get the big chunks. And again, that's where the money is. That's where the business model can make use of EV infrastructure and use data and software to solve the problem instead of just leaning on the 100-year-old legacy ecosystem to do it. That's getting blood from a stone if you try to do that.
That was Adam Jonas of Morgan Stanley. Now in China, we got a glimpse this week of how the ongoing U.S.-China trade tensions and pro-democracy protests in Hong Kong are weighing on the travel industry. Ctrip, which is China's leading online travel agency and parent of travel sites like Trip.com and Skyscanner, says it has seen shares decline as a result. Bloomberg's Tom McKenzie caught up with the Ctrip CEO, Jane Sun, in Beijing.
People probably still will travel, but maybe instead of traveling 4 times a year, they might reduce to 3 times a year. Maybe instead of traveling long haul, they might be traveling to Asia or within China. But I think travel for middle to high end customers almost is a natural during their Golden Week holidays, Chinese New Year, or summer break. They will bring their family to travel.
Is top line growth being weighed down by this near-term weakness in the economy?
The Hong Kong Taiwan situation, yes, it has a negative impact on our top line. But I think these are, one-time kind of thing. So we will see through it and still make a strong investment in the long term.
How would you characterize the impact, the broader impact of the trade war on your business?
I'm very hopeful that the leaders from both countries will have the wisdom to focus on our shared interest. And there are so much things we share together and maximize our shared interest. Only then I think both countries will be benefiting from our collaboration.
We know, of course, tourism in Hong Kong, into Hong Kong and out of Hong Kong, has been under significant pressure. Can you quantify for us how it's played out for Ctrip in terms of the demand from mainland tourists looking to travel and stay in Hong Kong?
The one-time impact we roughly estimated is around 5% of our total revenue.
About 5%. Okay. When do you expect that to turn around?
Hopefully, the area will be stabilized very soon. So again, I think both government and people will look into the future, right? Look forward what is the best for Hong Kong.
A big focus I know recently has been to grow in lower tier cities, so smaller cities in China.
Right.
How much success have you had there, and what are your targets for growth? There was one target I was seeing of an additional 50% of revenues coming from those smaller tier cities. Are you close to meeting that target?
Correct. We have about 8,000 offline stores, and the growth empowered by these offline stores is tremendous. And we also put lots of efforts in further penetrating into the third tier, fourth tier, fifth tier cities. And so far, it's working out very well. The year-over-year growth for lower tier hotels in lower tier cities is more than 50% year-over-year. So we are confident in that.
That was eTrip CEO Jane Sun. And coming up, part of Bloomberg's exclusive interview with Facebook COO Sheryl Sandberg, what she has to say about the social network giant's policy on political ads. And you can't mention Facebook without mentioning the Cambridge Analytica data scandal of 2018. We hear from one of the central figures to emerge from those events. It's Brittany Kaiser. Her comments on personal data and her new mission. That's next. This is Bloomberg. Facebook has seen its shares of recent rain clouds with antitrust issues, cryptocurrency pushback, and data breaches hanging over its head. One of the most controversial stances was recently announced by CEO Mark Zuckerberg, who said Facebook will not ban political ads, even those that are known to be false. In an exclusive interview after the company posted earnings Wednesday, Bloomberg's Caroline Hyde got perspective from Facebook COO Sheryl Sandberg.
We're not doing it because of the money. This is less than 1% of our revenue, and the revenue is not worth the controversy. But what Mark said is that we believe in free expression, we believe in political speech, and ads can be an important part of that. Where we're really focused, and I think we are leading, is on transparency. We put out an ad library. We now announced a presidential ads tracker, which means that you can see any ad anyone is running who's a political candidate anywhere in the U.S., anywhere in the world even, if it's not targeted at you. And that kind of transparency we think is really important to people understanding. You also talked about investing in protection. One of the things we talked about on our earnings call just now is the size of the investments we're making, prepared for 2020, working with election commissions all over the world, hiring engineers, using machine, using human reviewers, really doing what we can to make sure people are kept safe.
So when Twitter decides to go the opposite direction, does that make you question your own decision, or you still stand by the fundamental reasoning and transparency that you can bring?
Well, Mark has said on the call that, we've thought about this for years, and certainly we've been thinking about it now. And we fundamentally believe that political ads are an important part of the dialogue and can be important against incumbents, can be important for new views. But we also believe that free expression across the board is something that we stand for as a company. And people all over the world are using that. Certainly politicians are using that. But people are using it, and that's how you see our growth continuing.
Let's talk more a little bit about politicians, because it's going to be a tough year in terms of regulatory scrutiny. Do you worry about talk of the business model being under attack? How do you see your role in educating, particularly those on Capitol Hill, about this?
Well, I think we really have to help people understand that targeted ads and privacy are not at odds. We can do both. So if you're an advertiser, you're the biggest company in the world or the smallest company, and we have 7 million advertisers, 140 million businesses using our services, and you want to show an ad to, women in their 50s, that's me, who live in California, we take the ad, we show it to that person, we give you back aggregated results. We can do very good ads targeting that really makes ads good for people and really helps advertisers reach the right person without violating privacy. And that's something I think we need to do a much better job of explaining.
That was part of our exclusive interview with Facebook's COO, Sheryl Sandberg. And the Facebook Cambridge Analytica scandal of 2018 showed us just how vulnerable our personal data is online. And one of the people at the center of that Cambridge Analytica at that time, it was whistleblower Brittany Kaiser, has a new role and mission. We caught up with her at the Sooner Than You Think Tech Conference in New York this week.
So since becoming a whistleblower, I have sought to explain to people exactly how important their data is. Data is now the most valuable asset on planet Earth, more valuable than oil and gas. And on a day-to-day basis, this is being taken from you by companies all around the world that are making a multi-trillion-dollar industry off of your most private information. Now, that sounds a little gloom and doom when people think that they can't get their privacy back, but the truth is people have agency. There's a lot of things that we can do on a day-to-day basis to protect ourselves, and legislators and regulators are finally listening. There are fantastic laws that have been introduced to U.S. Congress and across different states that not only could protect us ahead of the next election, but could make sure that we live a more ethical digital life from here forward.
So what sort of legislation do you think sets the highest standard at the moment? We've seen California pass privacy laws. You know, you're working with Wyoming, but GDPR is something that Facebook itself has pointed towards in Europe as potentially being some sort of blueprint. Where do you think legislation is leading the way?
So I think with GDPR, the most important part of it is that it recognizes that your data is your property, and therefore you have the right to transparency. Who's collecting data on you? What do they hold? And what are they using it for? And if they want to continue to use it, you need to opt into that. Transparency and consent is the most important part of this conversation, which is why I'm really excited that the state of California has implemented a version of GDPR. That is going to come into effect in January. Also, Governor Gavin Newsom in the state of California has introduced something called the Data Dividend Law, which means that not only do companies need to tell you what they hold on you, but how much money they're making off your data and give you a cut of that. There's also national legislation put forth by Senators Ed Markey, the consent bill. That means that we have to opt in as a nation. Right now, everyone in America is pre-opted in to your data being collected, which is the opposite in Europe. You're pre-opted out, and you have to actually consent, right? Now, also Senator Mark Warner has an entire package of legislation that demands everything from transparency and consent to how your data is collected to banning negative use cases of your data and malicious use cases of algorithms that push kind of hatred and vitriol to the top of your news feed on social media.
It's interesting that at the same time as legislation is being enacted, we're also seeing the companies themselves react in many ways. Facebook announcing that they are having more third-party fact-checking, they are employing more people, the amount that they're spending on security, the fact that we now see Google moving to protect children more with YouTube Kids. What do you think about the steps being taken by the companies themselves and whether they go far enough?
I think that the investment that Facebook is currently making into stopping foreign intervention in our elections is incredibly important and direly needed. Unfortunately, we didn't have those protections in 2015 and 2016. Unfortunately, what Facebook is not recognizing is that the greatest threats to democracy are domestic, to our politicians being allowed to say whatever they want in their political advertising. I think that decision a few weeks ago to not give the same community standards that you and I have to abide to politicians is not only a massive threat, but will continue the problems that we saw in 2016, where everything from incitement of violence, racial hatred, sexism, and voter suppression tactics were used by the Trump campaign and the Trump super PAC and aided by Facebook.
That was Brittany Kaiser, now co-founder of the Digital Asset Trade Association. And coming up, crypto industry bigwigs descended on San Francisco as part of Blockchain Week. We hear from the CoinList CEO, Andy Bromberg, who touts a new big tech industry backer. Details next. This is Bloomberg. Security, economics, and products, they were all part of San Francisco's second annual Blockchain Week. The event was a who's who of investors, businesses, academics, and even regulators. CoinList CEO Andy Bromberg among those attending. He stopped by Thursday to share some news.
we are building an exchange. This is called Coinless Trade. We've historically run token sales. We've done primary offerings for new token projects, and today we're taking that and expanding it into secondary trading too. The crypto ecosystem is unusual. Historically, when you've run these primary sales, you've gotten these tokens afterwards, you need to move them to an exchange to trade them afterwards. Imagine if you bought shares in an IPO, and you had to move them onto an exchange to trade them after and go through a whole process there. It doesn't make any sense. We're changing that. We're taking sales that we've run the primary for, putting them on the secondary exchange, letting people trade them really easily.
I was chuckling a little bit because you said you are compliant. In this world, what does compliant mean?
Compliant means a lot of things, and there are a lot of agencies that have a stake in these matters. The SEC, the CFTC, FINRA, FinCEN, all these different agencies are looking at the space, and you have to make sure you're abiding by whatever regulations there are. The Coinless Trade Exchange will be trading cryptocurrencies, non-securities assets. And so we have to be compliant with whatever regulators are looking at that. In many cases, it's the CFTC, it's FinCEN, and we look at what they're doing and have to be really careful around those issues.
You know, when we talk about being compliant, I would be remiss not to bring up Libra. And they said that they would not launch until they had, quote, regulatory approval. What are your thoughts on Libra?
You know, Libra, I think, is a great thing for the industry. Facebook has more reach than almost anyone else in the world, and they are going to expose a lot of consumers to the idea of cryptocurrency. Once that happens, it's an open market, and people will compete for market share with Libra. You know, I think there are upsides and downsides to the details of Libra's design, but at the end of the day, they will expose a lot of people to this industry. That's something we are really excited about.
But how is that regulatory environment? Because you talk about how you've been working with your specific regulators to get compliance. Libra clearly has struggled to get people on board. How has the regulatory environment shifted?
Well, I think one big piece you have to look at there is that Facebook is not looked at kindly in DC right now for a variety of reasons, privacy issues included, and a lot of that is tainting the discussion around Libra. Some of the pushback they're getting is not actually specific to the Libra project. It's more about the issues that Facebook has had historically and how that might impact it. But there is some good news, and this has gone largely unnoticed. In the past couple weeks, Commissioner Hester Peirce from the SEC has started to talk about in public speeches in Chicago and Singapore and today in San Francisco about the idea of a safe harbor for crypto tokens. The idea that you might actually be able to carve out certain crypto tokens with certain attributes from securities law and allow them to be traded and issued more freely. That's something really exciting. We are far from conclusion on that, but she's at least talking about it and moving it forward.
And so you think by the fact that we're just talking about it more, despite some of the negative headlines out of Libra, it's good for the industry because more people are talking about it?
I think at the end of the day, they will find a way to launch Libra. There may be some hurdles they have to get over, some unexpected speed bumps, but they will launch it, it will ship, it will reach millions, maybe even more people, and that will be a good thing for crypto as a whole.
So a funding environment, a private company. We talk a lot about private companies, particularly WeWork, and how they have just changed the funding environment and private valuations at this moment. How was the funding environment now more difficult than, let's say, a year or 2 years ago?
There's a lot more scrutiny around business models. I think for a long time we were living in this ecosystem of growth at all costs, and if you could grow, you could raise money. Today, especially in light of the WeWork news over the past couple of months, investors are looking at business models. Can you actually make money with this business? And it's something we've been really focused on because the crypto industry, more than any other industry out there, goes up and down. It has crypto winter, it has crypto spring, and you have to be able to survive that. So for us, being able to build a real business that has a real business model, generates real revenue, has been incredibly important for building ourselves for the future.
And did your investors this time around really want to see that path to profitability more so than 2 years ago?
You know, I think for the most part, Polychain, who led the round, was already an investor in us. Jack certainly looked at this, but we had a lot of existing investors that had seen us do that from the very beginning, and that's why they re-upped their stake and got involved.
That was Coinless CEO Andy Bromberg. And that does it for this edition of the Best of Bloomberg Technology. We'll bring you all the latest in tech throughout the week. Tune in each day, 5 p.m. New York and 2 p.m. San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.